Hi, this is Tomiko Tolan from Cannex. I'm here today with Tim Paris from Rourke Consulting. We're going to have a great conversation about policyholder behavior, but I'd love to start with Tim telling us a little bit about himself and what he does.
Sure. Hi, Tomiko. Thanks for having me. Pleasure to talk to you. Yeah, I'm Tim Paris. I'm an actuary by training, a fellow of the Society of Actuaries and a member of the Academy in the US. I've spent, pretty much my entire career in the US annuity industry, and in some cases dealing with annuities outside of the US and around the world, part of the retirement savings and income industry generally. So glad to talk to you about my experience in this business, and in particular about policyholder behavior, which I think is what we're going to be talking about today.
Yeah, so actually let's start with just some background. Tell me what policyholder behavior is.
Sure. I think when most people think about the insurance business, and particularly life insurance and annuities, you tend to think about the most familiar things that have been around for a long time, like life insurance, which provides protection for people in the event of premature death, well, provides financial protection for their beneficiaries. And so when you think about the risks in those kinds of products over the centuries, it's basically a risk of mortality, people dying. It's not usually elective, fortunately. So with large numbers of policyholders, insurance companies, the math on insurance companies having an understanding on the risks and the costs they should be charging to provide this insurance to people is pretty straightforward. What's crept up in the annuity business, which I've been involved in for my career the last 25 or so years, is that there are a whole lot of other features beyond death benefit guarantees that have become very prominent, that have become very key aspects of these products and have driven sales and asset growth and all that in the US and around the world. And a lot of these features are not triggered by death, they're triggered by living. And to put a finer point on it, it's living and keeping your annuity in force. It's living and choosing certain kinds of income features on the product, when to start, when to stop, and so on. So there are a whole lot of elective choices that the annuity owners can make. And that makes the risks a whole lot different than what most insurance companies and people are probably acclimated to from over the centuries of traditional life insurance providing mortality protection. So when we talk about policyholder behavior, we're talking about those elective kinds of choices that people can make, either with an annuity, and in some cases you find these similar types of elective aspects on different kinds of insurance products as well, life insurance products and other lines of business as well.
So, as you pointed out, the policyholder being able to make a choice in their behavior, it's really different from what we traditionally think of for insurance, like house burning down or death. So how different is this for the insurance company to manage, and how did we get here?
Yeah. I can answer in terms of what I'm most familiar with, which is annuities, in particular individual annuities in the US. And so that would cover things like variable annuities, fixed indexed annuities, and in other instances, including fixed deferred annuities in some cases. But you see a lot of these principles around. And a lot of this has really come to the fore, I would say, from the late 80s going forward, where you tended to see a lot of these living benefit type features introduced on these products. And I think the thought process was on the part of the annuity companies, yes, it's attractive for a prospective annuity buyer to have some sort of a death benefit guarantee on their product, which is very much akin to traditional life insurance. But I think the thought process as we got into the early 90s, mid 90s, is that, wow, can we as an insurance industry offer benefits that don't require people to die to get it? That sounds pretty attractive. If we can offer guarantee features that people can enjoy while they're living, whether it's through a guaranteed minimum accumulation value, which were some of the early generations of this in the 90s, to guaranteed minimum annuitization streams into late 90s, early 2000s. And then over the last 15, 20 years, it's really been things like lifetime income streams that are guaranteed. So If you have an annuity, you can take a certain amount of annual income out of your account value. And in the unlikely event that you exhaust the money in your account, you may still get an ongoing income stream, either for as long as you live or as long as you and your spouse live. And so that was really the genesis of it, to get beyond just merely having a death benefit protection for beneficiaries, to give something to the annuity owner while they're living.
Okay, that makes a ton of sense. And I would also propose that I think that changes in the tax benefits of annuities really force the industry to look at things other than annuitization as far as providing a benefit, because most folks are just really traditionally have been holding on to these policies, but that's neither here nor there. So tell me how considerations about policyholder behavior affect product management and pricing.
Sure. Yes, it's very important. So if you think about the base kind of economic proposition for an annuity, and let's use a variable annuity as an example, which at its core, in real simple terms, you could think of it like a collection of mutual funds inside a tax deferred wrapper. These are generally sold through some kind of an intermediary, whether it's an insurance agent or financial advisor, and of course that person gets paid some sort of a commission and or a trail commission from the issuing company to do the sort of work to educate the buyer about how the product works, to provide ongoing service on what options they can choose at different points along the way. So the base proposition for the variable annuity, and it's very similar for fixed indexed annuities as well, it's primarily an investment proposition. You have the ability to allocate your investment among a number of funds. You can reallocate between those investments without incurring a taxable event. That part of it isn't terribly complicated or worrisome for most annuity companies. What is worrisome, though, is when you start overlaying these guarantee features on it. Oftentimes there's a death benefit guarantee, and then on top of that, there's a living benefit guarantee. And the cost of it, the term of these guarantees is generally for the life of the annuity, and so the life of the annuity owner. And when you think about the target market for these products, it's generally to people in their late 50s, early 60s. You think about increases in human longevity in most countries, and you're talking about a product that could be in force for 30, 40 years, maybe even more. And so when that is the long term of the product, companies and their actuaries on staff and their pricing and product design people need to not only have a reasonable guess as to what mortality is going to be or how often people might terminate their policies for the next year or 2 years after that, they need to have a sense of this over a 30, 40-year time horizon. So it's very challenging analytically. And even if you're off by a little bit from 1 year to the next, you have a real sort of compounding risk that, wow, if you're even off by a little bit, and you extrapolate that for 30, 40 years, you could be really off by a lot in total. And so they need to make sure they get these estimates right of how much people are going to use these benefits, so that they could set aside the right amount of reserves and capital to meet those guarantees as they come due, regardless of market performance over the product's lifetime. So whether equity markets are up or down, interest rates are high or low, the American insurance industry needs to be ready to meet those guarantees, and that's something the regulators have rules in place to guide them to do that properly.
So just to be really clear here, then, the management and the pricing really are affected by these assumptions about policyholder behavior, right?
Yes, it's very important. And when you asked me the question about the history of these product features, and I said, I think a lot of these features really only go back 30 or 40 years, and yet we're talking about features that could be enforced for 30 or 40 years future. And even in the history, there's been a lot of innovation or different generations of these benefits that have become popular, that have kind of come and gone in some instances. So really the upshot is we're sitting here in 2021 is that for a lot of these most popular features, they really haven't been around very long, maybe 15, 20 years or so. And the actuaries and the insurance companies need to put their best efforts to put in these estimates for their pricing and product management for a very long period of time going forward based on what is maybe only a relatively short period of data to work on. So, that's the tricky thing with innovation. The features sound great. They may all be great. They may be great in the future. But you have to start somewhere, and you don't always know whether you're going to have it right to start out with. So now, as each year goes by, companies are looking at the experience data for policyholder behavior, whether it's surrender rates, income utilization rates, mortality, longevity rates. And each year, generally we'll go through a process comparing, okay, how well does this year's experience compare to what we had expected last year? How does it compare to what we expected when we initially priced and offered the product? So it's really important.
Yeah, thanks for getting a little deeper into that, because I just want to be really clear with people that this is something that is really crucial to how these products are priced and managed. I think that that's very much underappreciated in general, outside of, say, the actuarial circles. So I'm just wondering though, can you give me some examples? You don't have to name names,
Sure.
of situations where folks have missed the mark and companies have really not landed correctly on it.
Sure. Yeah. When I think back over the last 25 years in the individual annuity market in the US, I think there have been a few rounds of problems. I kind of use that term loosely. The initial round that I can recall was in late 90s, where there were some, I'll call it product design defects that were certainly not intentional by the annuity companies, but there were certain things in the design that left open the possibility that people could manipulate the death benefit guarantee. They could basically strip the money out of the account value, leave a relatively small amount invested in the annuity with a huge death benefit, which is really a problem. So that was one generation, which was pricked. It was an expensive problem for a few companies, but the fix was obvious for most people in the industry. But it really wasn't until we got into the credit crisis, 08, 9, and 10, and so where we started to see policyholder behavior, problems, if you will, where elective behaviors were turning out to be quite different and more adverse than what the insurance companies were expecting. And a lot of these things really don't come out until a crisis happens. So, when equity markets drop 25, 30% in a short period of time, when things are very volatile, when interest rates are moving in extreme ways, and things are going on with all sorts of other investments and asset classes aside from annuities, you tend to learn some things about how people are going to use these complex guarantees. And so really the main thing we saw during the credit crisis and in the years following is that termination rates for annuities turned out to be much lower than what folks would have expected ahead of time. And, on the one hand, we could be a little sympathetic that a lot of these were relatively new features, and folks did the best they could to design and price them to try and anticipate that in times of market stress, people would probably hold on to their annuities at higher rates and probably not surrender something that provided a valuable guarantee. On the other hand, as it turned out, things were a little worse than what folks were expecting. So the level of lapse rates was lower, which means that the amount of policies in force was higher. And of course, following big equity market drops, the amount of exposure to the guarantee features was much higher. And as this persisted during the credit crisis and for the few years following, we started to see something that I don't think we really ever saw before in the annuity market, which is annuity companies were, in their financial disclosures quarterly, annually, when they talked about their financial results, they were saying that they needed to strengthen reserves to meet future guarantees. And in some cases, I could think of 4 or 5 off the top of my head where these were huge numbers, hundreds of millions of dollars of reserve strengthening, in some cases even more than that, because if you're going to say it harshly, you'd say they got the policyholder behavior assumptions wrong. If you're going to be a little more generous about it, you could say, folks did their best and it just turned out that reality was a little tougher than what they were expecting. But either way, it was a very expensive period of time. And so, these were in the public disclosures. I can remember 2011, 12, 13. And then interestingly, we've seen the same thing come through in our analytical work at RUARC over the last 12 months, where, with all the volatility in the financial markets last spring, with the onset of COVID, with interest rates being at historic lows, we really saw this is kind of called a third round of really adverse changes in policyholder behavior with very similar effect. In crisis periods, policyholders have an attractive guarantee, one that's hard to replicate in other products. They will tend to keep that product in force as most people would. So what's going to be really interesting now for us sitting here in 2021 going forward is to see were those changes we saw last year a one-time blip because it's a once in a century event, knock on wood, or is it something that's going to persist like we saw following the credit crisis 10 years ago, in which case that could be a very expensive proposition for annuity companies as well.
Great. So I'd love to hear more about your findings, and we can kind of dig in. There's a lot in there, so I'm really excited to talk about this.
Oh, sure. Yeah, thanks. We've been since 2007 at RUARC. This has really been our bread and butter in our work. So we're a consulting firm, but we're very much a niche consulting firm, and so the core of our work products for clients revolves around what we in actuaries will call experience studies, and what we do are industry level experience studies, policyholder behavior. So the data contributors in our studies are the annuity companies themselves, both for variable annuities, fixed indexed annuities. We gather monthly data at a policy level going all the way back to 2007. And each year we'll add another year's worth of data, and we'll do our analysis of what has happened historically. So what are the major segments that we see in the market? For example, how does policyholder differ between contracts that only have a death benefit guarantee versus contracts that might have a lifetime income guarantee? How does that behavior vary depending on whether the guarantee features are more or less valuable in response to market movements? We look at differences by age, by gender, by distribution channel, by contract size. It's really quite complex. And we also look at the time series of all this data as well, because even if you feel like you understood all the data relationships in this data over the last 8 or 9 years, then a year like 2020 comes along and all those relationships are largely still true, but the numbers are a little different. And there's movements from one year to the next. So that we're really analyzing surrender behavior, income utilization behavior. There's a certain class of guarantees that provide a guarantee upon annuitization in the classic forms at GMIBs. We analyze those annuitization rates as well. And then every few years, we'll also do a mortality study to try and identify different kind of mortality selection effects between death benefits, living benefits. We try to study whether, the extent to which mortality has been improving over the many years, in step with the population. We're picking up about 70% of the industry in our studies for variable annuities and fixed indexed annuities. And so when we do our analytical work on all that data, we can see things in that data that even some of the biggest individual companies in the market can't see. And it's just a question of data volumes and credibility of conclusions, and giving folks a much higher degree of confidence than they would of just looking at a smaller data set from their own company. And then the actuaries in turn for their companies, they're using our data to help inform their pricing and their product management to hopefully do a better job of designing products and making sure that they can price them properly so that they're sustainable.
So tell me some surprises that you saw from the 2020 data.
Wow, yeah. I don't know if it's a surprise given all the things we've lived through, but one of the big things that we noticed in the 2020 data for variable annuities in particular was that anything that required a specific election to do was slowed, particularly in the second quarter. With onset of COVID, social distancing, people were not going to offices, all the usual meetings that annuity owners would have with their financial advisors and agents to talk about how their policy's performing, what they might want to do as part of their retirement plan. It seemed like that was just a chill was put into that so that folks just didn't do anything for a few months. And we will see whether that continues. Now, I suspect we'll see a bit of a reversion to prior things, even as early as third quarter, fourth quarter of 2020. Once everyone and their grandma learned how to do Zoom calls and got used to social distancing.
I'm wondering though, how much of the quickness of the market drop is going to affect future behavior, meaning, a lot of folks may not have realized as much additional value in what was embedded in their guarantees. I mean, do you think that to some extent this slowness is going to maybe insulate the carriers from some of that policyholder behavior?
I think perhaps, because these are really long-term guarantees, like lifetime income guarantees, it's not like a point in time guarantee where, if the stock market drops 20%, someone could just cash in their annuity to make up the difference. That's not the nature of this. It's the stock market dropping, your account value dropping, that in a very broad sense, that should make you appreciate the value of having a lifetime income guarantee, but you're not going to immediately monetize any of that. So yeah, I think in the very short term, it probably slowed any maneuvers people might have done with their policies in terms of starting income or terminating their annuity or rolling it into a new version of the contract. But it doesn't necessarily extrapolate. And that's why, as we've talked about the results of our studies over the last 6 months or so with our annuity company clients, the nature of the discussions is more, wow, things really changed a lot in 2020, even after accounting for all the market volatility effects. And don't necessarily assume that that's going to continue indefinitely to 2021, 22. It may not continue permanently. But when you're doing this kind of work and when you're an insurance company, you need to be able to distinguish, even if it's a one-time blip and a big one, you need to be able to distinguish that from the underlying trend so that you know where you are at any point in time. So I think the jury's still out. I think we're really, as much as I was really proud of the analytical work we did on the 2020 data, and our next round of VA studies will be over the next couple months, which will take us through analysis of the end, through data all the way through the end of the year. That should be even more telling. I think it's going to almost be even more interesting as I think about doing these studies over the next year, 2 years, as you look at where the stock market is now. It's just one belt, the S&P 500, the Dow where it is now at all-time highs relative to where it was 12 months ago. You can't just point to what happened in middle of 2020 and say, well, gosh, that's just a reaction to extreme market drops. If things stay the same after the market rebounds as it had, that's going to be a real cause for concerns for the industry. So I think we're going to learn an awful lot about 2020 as we get through the next year or so. It's not so much what happened in the spring and the summer of 2020. It's how do folks react to the rebound coming out of that? And has policyholder behavior changed? Has folks' appreciation for the value of these guarantees changed? And that might cause issuers, to fine tune what they're offering as well in response to what folks seem to be interested in or less interested in.
So when you're talking about the change in behavior, meaning a slowdown, does that equate to basically greater persistence and lower election rates of starting the income?
Yeah, greater persistence for sure. I think that's one where I think traditionally you don't often have annuity owners kind of going off on their own, terminating their contract. And a lot of this has been, as I said earlier, this has been a market of pretty rapid and quite significant product innovation over the last 15 or 20 years. And it's quite possible that, folks, bought annuities 5, 7, 10 years ago, still have them in force and are looking around at what's available now and might like something new that's come along better. And this is a pattern that we see in this market where a lot of the terminations are not necessarily to cash out, to put money in people's checking account. A lot of the terminations are to roll money into a newer product, possibly a different guarantee. So that, that's another aspect of this. When we talk about terminations, it's not just, are you unhappy with what you have? It's what are you going to do with the money? And is there something you might like better?
I think that's really tough though, after any period of economic turmoil where you end up with products that are not as rich as the previous generation of products. I mean, we certainly saw that after the financial crisis, that there was, a massive repricing effort. And, I think that ultimately, that transformed over time. But, anybody who could go back to 2007 and buy a GLWB would love the opportunity to do that. And I think the same is going to be true for a little while, as well as, some choice being taken off the market. Again, it's a similar type of turbulence. So, I'm not sure, like, I would imagine that factors into some of how you view that behavior change.
Definitely. And we're really mindful of that. And of course, all of our annuity company clients are mindful of what I'll call product generations or product vintages. There are certain things that we will probably never see again, like as you said, so that kind of 2004 to 2007 vintage of variable annuity guarantees is a tough act to repeat, given the lessons that were learned during the financial crisis. But I think the other thing that's very important here that it didn't so much talk about explicitly, but we should, is the level of interest rates. So when you think about 2020, of course, COVID and the public health issue of that, we had all the stock market drops and volatility in the spring, early summer. We've had a big rebound since then, but we also had interest rates at rock bottom historical rates. And even now we could say, wow, interest rates have generally increased in the last 9 months, 12 months, but they're still really, really low. And when you're talking about products, variable annuities, fixed indexed annuities, lifetime income guarantees, they're very long term, which makes the cost to provide them really, really interest rate dependent, along with the dependence on equity market performance, along with the dependence on policyholder behavior. And so I think everything else being equal, low interest rates makes the cost to provide these guarantees much higher for the annuity companies. And so when we think about, well, what might happen in 2021, 2022? Well, we've already seen equity markets rebound. We've seen interest rates come up quite a bit from where they were a year ago. And if interest rates continue to rise, that is going to relieve a whole lot of pricing pressure that this industry saw over the last 10, 15 years that was specifically due to low interest rates. And so that should, if you're thinking about it from the annuity buyer standpoint, that should very much help them when you think about pricing. So the cost for them to be able to buy the same guarantee, everything else being equal, should be lower to the extent interest rates go down in the future. So I think that should be a good thing. It might not be a return to the pretty wild set of options folks had 2005, 6, and 7, where there were just guarantees available on a whole range of different kinds of investment platforms, different kinds of mutual funds. I think the industry has learned that those kinds of risks are really kind of open-ended and are not really manageable. But once you've kind of tamed the investment platform and have a sensible set of funds inside of these products, I think the industry has learned how to provide these guarantees, manage them in a financially responsible way, and price them in a sensible way, so that to the extent interest rates go up, that should make everything else being equal, the products more attractive pricing wise to potential buyers. So that would go for VAs as well as fixed index annuities as well.
Okay, that makes a ton of sense. Now I'm just wondering about how policyholder behavior then kind of feeds back into product design. Like, what is it that carriers are currently doing, and what do you think that they might do in the future?
I think it's gotten quite, I'll say, granular and detailed. Now that there have been, several, as we talked about, several generations of these products over the last 20 odd years. And even for some of the more recent vintage ones, like your lifetime withdrawal benefits on variable annuities and, similar types of benefits on fixed indexed annuities. We have experience data now at an industry level that reaches back 10 or 15 years on these, which is very important. It's way more than anybody had when they were introduced, where it was kind of best guess and cross your fingers. So I think with the benefit of all that data, companies have a much better understanding of where the differences are, whether it's differences between product types or subtypes, possibly differences by distribution channel, differences by age and contract size and things like that. So I think companies can be much more detail oriented on their product design. For example, like their new business limits. One thing we always talk about with our clients when we talk through the study results is that there are a whole lot of factors that influence policyholder behavior, options, elections. But one of the ones that really seems to matter is differences in policy size. So we generally see younger people have smaller policy sizes, so that probably makes sense. Older people tend to have somewhat larger policy sizes. But when you really get into the extremes, like under $50,000 premiums, over $500,000, $1 million premiums, you see quite a big difference in behavior there. And it's the reasons for that are really open to discussion. Maybe it's the level of understanding on the part of the buyer. Maybe it's the amount of attention and guidance they're getting from their financial advisor, their insurance agent. But the differences there can be quite different, and that's going to impact the cost to provide those guarantees for the companies. So I think when companies design their new business limits, like how big of a contract are they willing to issue without home office approval or ever in total, I think they're much more mindful of those kinds of issues. That on the one hand, it'd be nice to treat everyone exactly the same way. On the other hand, when the data shows you that there are certain segments of this market that behave differently, and probably for good reason, how can you do anything but factor that into your product design and pricing?
So that's a really interesting question, because it sounds like what you're saying is that folks that have larger policies, they may well be more likely to have qualified advice, right? And they're making more economically efficient decisions about retaining the policies or electing to start them, as opposed to folks with smaller policies, which is kind of the opposite dynamic that we usually think of in terms of volume. We think of, you're able to save money if you put more into a thing, right? Because you can charge less fee, the carrier or whatever mutual fund can charge less fees. We certainly see that. But do you see differential pricing, or how do you imagine handling differential pricing to target certain markets? Is it really just to kind of cut the head off and say, no, we're only going to serve like the middle market that really needs these benefits, but may not be managing them well, which also sounds really bad, by the way. But anyway.
Yeah, I think how companies approach that, the marketing, is going to vary, and some might not do a whole lot explicitly to try and target one segment or another. But I think there's certainly an appreciation, especially at the extremes. I guess I would say it a little differently, that the average premium size for an individual annuity is probably something around $75,000, give or take 50, 75, that kind of range. The minimum premium is usually much lower, $5,000, $10,000, something like that. The maximum without a home office approval is usually like $1 million, maybe even $2 million or something. So that's a huge range, a factor of 100, 1,000 of what the outcome can be. And I just think there's much more an appreciation for how the behavior can be different depending on where you are in that curve. So companies might not do anything explicitly in their pricing to say, okay, these $1 million cases by buy these products and they're super efficient, so we need to charge them more explicitly. I don't think I've really seen that, but I think it's more behind the scenes. There's kind of a weighted averaging going on of expectations to make sure that they're not doing anything silly. But there are other examples come to mind beyond contract size. I mean, one other big issue for the individual annuity market is that contracts that have some type of a lifetime income benefit, a GLWB, a GMIB, everything else being equal, they tend to surrender their policies at much lower rates. And directionally, that makes a lot of sense because they were, usually you have to elect these things at the point of sale. There's usually a pretty significant additional fee for them that's ongoing. And you probably wouldn't do that if you didn't see the value of it, right? So there is kind of a natural sense that this provides a lifetime income guarantee. And therefore, if I want to recognize the value of that lifetime income guarantee, it would probably be silly to surrender my policy within the first 5 years or 10 years. So we tend to see much lower surrender rates for those kinds of benefits, which again is another thing that we see in our studies, our clients see in their studies, and that behind the scenes they're factoring into their own pricing expectations as to what the fact that surrender rates are going to be different depending on whether a contract has a living benefit or not, and all the other sorts of finer details around that point.
Yeah, I mean, that seems pretty obvious, frankly. But so, I mean, I certainly have thoughts about like issues with people with the smaller policies not really getting as well served by the product. So they end up subsidizing the larger policies to some extent, but I don't want to dwell on that. What I do want to talk about though is the advice piece, right?
Mm-hmm.
And so we're seeing this real trend right now within the industry towards RIAs, right? Trying to encourage them to engage more with these products and use them for their clients. And in my experience, this is an advisory population that tends to be very sophisticated. They really understand how the products work. They tend to be much more aware of that.
Mm-hmm.
And the fee structure is really different, right? Because they're getting, an annual advice fee, right? So they have to be actually doing something. And one of the things that they can do with these products is keep an eye and make sure that they are doing the best thing for their client in terms of when to turn on that income. So I would imagine that the expectations around what is currently a pretty small segment of the market, as it expands, that's going to affect the assumptions from the carriers. I mean, do you see that in the work that you're doing right now?
I don't know what the carriers are doing now, but I agree with you. I mean, I can remember from the early 90s, this segment existed at that time, and it was quite small then, using usually a kind of a no surrender charge, levelized commission sort of product or no commission sort of product for an RIA platform. And it does seem to be kind of on an upswing now. And what's different from the early 90s to now, of course, I think the main thing in terms of product features is that you have all these living benefit, these lifetime income guarantees. And it may be the most fundamental thing that folks who don't spend every day of their lives like me involved in this should remember is that, why is it called an annuity, whether it's variable annuity, fixed index annuity? An annuity means there's a series of payments, and it's usually a lifetime income series of payments. And so what an annuity can uniquely provide is that lifetime income guarantee. You cannot get this on a bond portfolio. You cannot really do this synthetically with any sort of collection of what we'll call normal investments outside of something within the insurance world. So, just like the special purview of life insurance is paying beneficiaries a guarantee upon death, special purview of annuities is to be able to pay lifetime income. And I think no matter what your distribution channel is, no matter who you're talking to about your financial advice and your retirement savings, retirement income planning, surely there is a place for a tool that can provide a lifetime income guarantee. So it's it's nice to see that there does seem to be more interest in this segment, in the RIA segment of the market, on how to use annuities in some way as part of the solution. And that's not to say that everybody ought to have a variable annuity. Invest all your retirement savings in a variable annuity, maybe not, but figuring out some way to apply some of these features in that context, I think, is important. And you're right that that type of advisor, the type of planning discussions could be quite different than what a lot of folks have been accustomed to through financial advisors and bank distribution and wirehouses, which has been the driver for most of the last 25, 30 years in the individual annuity market.
Sure. So, now as far as driving some policyholder behavior, we know that for a long time, a lot of these products have offered a deferral bonus to kind of get people to delay the initiation of that income. And, potentially if you delay long enough, you're just not going to be able to live long enough to really reap the value of that guarantee. And but it seems like the FIA study that you did, you had some really interesting results around when people are electing and kind of what they're sensitive to. So can you talk about that a bit?
Yeah, definitely. This can get really kind of wonky with the technical bits and the modeling, but I would say, before answering, the concept is very similar to something I think most people, even non-annuity people, would be familiar with, which is, good old Social Security in the United States, where, you can start your Social Security at age 65 and you get one level of monthly income. If you want to start it at age 68, you're going to get something higher. And why is it higher? It's because you're starting later. And so on average, there are going to be less payments for the same level of life expectancy. So that's at the root, that's kind of the same root issue as what we have here for these lifetime income guarantees on fixed indexed annuities. And it's actually quite similar on variable annuities as well. And the gist of it is that in the product offering, it's usually stated, kind of oversimplify it, but it's usually stated like this, that you could buy this income guarantee, you're going to pay whatever, 100 basis points extra fee, or whatever the annual fee is on your account value each year. And if you start income now, you get income at a certain specified level. If you start income later, we're going to kick it up to a higher level, but of course you're starting later. Now, if the insurance companies are doing a good job, if the actuaries are doing a good job, those things should be about equivalent on an actuarial basis, right? Just like the starting later on Social Security should be about equivalent to, starting at 68 or 65. The issue is you don't really know. You can't paint with broad brushstrokes here. And what one company might have done for their bonuses, their deferral incentives, could be different than another. And so it will depend. And it warrants some very careful analysis as to what's best for you, Tomiko. Is it best for you to start year one, or is it best for you to wait for something more starting at year 11? The answer for you is going to depend on, well, how long do you think you're going to live? Who knows? You may be right, you may be wrong, you may live much longer, you never know. But it boils down to those kinds of considerations. And what we're seeing now, and we have, for years, we as analysts of this data, actuaries and all the annuity companies wondered and wondered about, well, what would the take-up rates be when they offered this sort of choice to annuity owners? How many would start in year one? How many would wait to start later? It's important to know, because maybe it's not pricing neutral, if you will. Maybe there is a different cost that they're trying to, maybe they're trying to incentivize people to start earlier, to start later. Don't know. I'm not saying one or the other, but it's not necessarily equivalent. So for years and years, we just didn't have enough data. There was no data out beyond duration, 8, 9, 10, 11 to know, well, were people utilizing at low rates because they didn't understand the product and were very inefficient? Or were they quite smart and were waiting to start something later for a higher benefit? We have that data now, and we spent a fair amount of time in our latest studies a couple months ago talking about the conclusions there. And what we've seen, real roughly, is that the commencement rates for income on these types of guarantees are quite high in the first year that folks can take them. And they're quite high in the year right after these bonuses kick in, which is usually around duration 10 or 11. In the intervening years, it's quite low, maybe half of those rates. So there is quite an interesting mix of people. You've got the income now people, and you have the income later people, and then you've got kind of the income starting a little bit in between people. So we have that data now for folks to look at, and the companies will have to, as they do their own studies, as they reflect this through their financial results, we'll see how well this emerging experience that we can all finally see now over the last couple of years jives with what folks were expecting in their pricing. But it's exciting. It's exciting to see, because there was no such data as recently as a few years ago.
Cool. So what about the sensitivity to, moneyness, or, the value of the benefit being greater than the account value?
Yeah, that's a big one. And this kind of really magnifies the importance of what I just said, that, for 20 years or so, annuity companies and actuaries would talk about what they would call they use the word moneyness, which is a kind of a weird sounding word to most people. But all that means is that kind of the relative value of the guarantee as your fund value goes up and down. So when fund value drops, the guarantee is more, quote unquote, in the money, and that should make the value of any guarantee you already have more valuable. And we tend to see lower surrender rates when that happens. So talked about that in 2020. We talked about that in the credit crisis earlier. One of the real open questions over the last 15 years is there a similar sensitivity around income commencement? So when fund values drop in a market crisis, are people going to start income at a higher rate because they realize, well, this is the thing they bought this rider for, right? This is the thing they've got this feature for, to protect them from the market vagaries. They'll know they have a level income. And we studied this for years and years. And even at the industry level data that we have at RUARC, we couldn't really see that emerging, which was kind of weird and kind of annoying. But what we've seen now, and we could only see it because we have a lot of data emerging finally beyond that year 10 mark that we talked about, is there is actually a very strong sensitivity on moneyness for income commencement. But you don't really see it until after those deferral incentives and bonuses kick in. And so in those instances, so like during the first 10 years or so, there's not much of a difference. There's not a whole lot of sensitivity to people starting income at higher rates as equity markets go up or down. But once you get past that bonus period, if there's a significant drop in equity markets, people have started commencing these income guarantees at a much higher rate, like in order of magnitude, like by a factor of 2 or 3 or so off the top of my head. So, and that's a huge difference relative to what, but by any baseline, that's a huge difference. And again, there was just no such data for folks to even look at like this as recently as a few years ago, but now we have it.
So just, you don't have to give me specific numbers. What is the scale of the election rates? Because that's always very surprising to me when I hear this.
Yeah, I mean, it's going to depend on the product and the company and all that kind of stuff. They tend to be pretty low overall year to year, like single-digit percentages. But they can double or triple when the guarantees become more valuable in response to market movements.
So cumulatively, we're talking about, still even after 10 years, like, barely double digits typically, and then maybe going higher than that if there is some significant moneyness embedded in there. Is that the right way to think of it?
Yeah, cumulatively, I mean, for blocks that have been in force for 10 years or more, it would be much higher than that, maybe 50% thereabouts. But the question, it really goes to the fact that it's a double-edged sword, because these product features are quite complicated, and we talked about what do we mean when we say policyholder behavior. We talk about all these elections and choices the annuity owner can make or not make or take at different times. And they're going to take them based on what their own financial plan is. And so there are some people that will buy an annuity because they want to take income right away, and they're going to do that right away. There are others that might buy it so they can sleep at night. So they know that, well, I don't want the income now, but I like the idea that I could start it after 5 years or 10 years, because maybe I'll need the money then, or maybe I might need the money then, and I could get a bigger benefit at that time. And so that might be what they were planning all along. So I don't think there's a unique right answer, or like I wouldn't get carried away with, oh, in totality, the overall election rate or income commencement rates are still, 40 or 50% or somewhat low. That sounds low. It may be that folks buy it because they wanted to sleep at night protection. There's nothing wrong with that either.